All right, what's up, everyone? We got to talk about the recession obsession. Everyone is obsessed with talking about a recession right now. The stock market's crashing, pricing in all types of recession fears, and the SOM rule is one of the things that everyone is talking about right now. So we'll break down the SOM rule. Okay, we'll take a look at it on Thinkorswim. We'll go over David Rosenberg's opinion on it. But to me, more importantly, unemployment is really the thing that you want to be looking at right now. Of course, the SOM rule, looks at unemployment in a little bit of a different way. But we'll show you guys my opinion on why the unemployment rate is a really big problem potentially for the economy right now and the stock market. We'll also take a look at the EPR model. Okay, this is the employee population model, employee population ratio model. And then we've got to take a look at where we are in the economic cycle, and it does not look good. Okay, this is a script I made based off of this here, going over expansion, peak, contraction, recovery. The four basically phases of an economic cycle. We'll break that down. And then on top of that, we have the Fed funds rate and the inverted yield curve, potentially about to, uninvert. We'll go over what's happened in the past on that. You can see the past two times led to some significant sell-offs in the market, and those were right before the dot-com bubbles and the great financial crisis. And then even when you look at the gold-copper ratio, this is another thing signaling a potential bear market or recession here coming in the future. So we'll kind of cover and go over the recession obsession. We've got some major breakouts here, major moves in credit spreads. This is a very big deal. So we'll talk about all of this in today's video via a couple different credit spreads, measurements, and everything. It's going to be a really good one. We're going to clarify, okay, basically all of the big warning signs, right? What are the real things that actually matter and could potentially cause the U.S. economy to go into a recession or, the stock market to go into a bear market. So it'll be a good video. Be sure to smash the like button and subscribe to the channel for more. Now, as always, the content provided on this channel is for informational and educational purposes only. It's not intended to be relied upon as legal, financial, or investment advice. So be sure to read through that disclaimer. I've also got the investment intelligence newsletter where I give out free, valuable finance and trading related content. Lots of really great stuff inside of there. You can sign up for that. That's completely free. There's a link in the description. And there is a website associated with it. So if you just want to go ahead and check out the website, read some of the previous articles, and different things like that, and basically try it out before you have it sent to your email. You can do that. Okay, you can check out the website. You can also get into the investment intelligence private trading group for just $1 right now. I forgot to do a 4th of July sale, so I'm letting people get in for just $1 for their first month, and then after that, you can decide if you want to stay and pay the regular monthly fee. Inside of there, you get 20 plus swing trade ideas every week, custom scripts and indicators, exclusive intel, exclusive chart layouts, much more. Right, a lot of the charts that we're going to be looking at, basically every single Thinkorswim chart in here is available to all of the Discord members as a chart layout. So you guys can keep up with these charts, and I've already done the hard work for you. You just have to simply copy and paste it right into your Thinkorswim, and it'll be there for you. I also did warn a lot of people, on YouTube and also in the Discord of a potential drop coming. To be prepared for that drop and not really rush into any big positions, and how the time to get into big tech was, in April, May, and also even June, before a lot of the bullish data that we had was going to play out. And obviously it's been a good time to be sitting out of tech. Now, this is the real-time Som Roll indicator, okay, and it's at 0.53 right now. Now, the shaded areas here are recessions. Each time we cross above, you see that we are in a recession, right? And you can take a look at it here. If you didn't know, you can actually get economic data on Thinkorswim. So it's a really great platform for you to get all of those things all in one. This is the real-time Som Roll recession indicator, and it is crossed above 0.5, right? It's at 0.53 right here. You can see all these shaded recessionary areas, and it's a big thing. It's a very big deal. Everyone is talking about it. This is everyone's new favorite indicator, right? And you have Dave Rosenberg here saying how the Som Roll triggered the recession call today. Chart here shows the 80 plus basis point jump in the jobless rate over the past year is a 100% ironclad indicator that the downturn has either arrived or about to. So this is a pretty bold claim, 100% ironclad indicator that we're basically in a recession or about to be in a recession. The Fed is as behind the economic curve now as it was behind the inflation curve back in 21 to 2022. So remember when the Fed kept telling everyone inflation was transitory, and then inflation just kept running, going higher. That's basically what he's suggesting right now. Now, that's not much of a bold claim. The Fed is known for being slow and lagging. But the woman behind the Som Roll, okay, she honestly thinks that maybe this time is different, right? And that's a very tough thing to say. I'm sure she's saying that because there's a lot of bulls pressuring her. Maybe she works for funds or a lot of bullish clients. She has a lot of bullish clients, and they're trying to convince her otherwise to say, "Hey, don't tell everybody to panic sell right here." So, it's really interesting. She just did an interview with the Compound with Josh Brown at the Compound. It's a really great interview. You should watch that. And she goes deep into her indicator that she made and what she thinks about it right now and why potentially it may actually not trigger a recession for the first time. We'll see. But for right now, this is part of the recession obsession. Okay, everyone's obsessed with the recession right now. But to me, unemployment is the big scary thing right here. Okay, if we take a look, and what I really want to show you guys more so is that whenever the unemployment rate, does this right here, right? Let me get a white drawing tool right here so you can kind of see a little bit better. All right, but whenever the unemployment rate comes in here and makes these rounded bottoms, right? Makes these rounded bottoms over here, right? Over here. I don't have to, point all of them out to you guys, but I'm doing it to make it nice and simple. A recession follows afterwards, right? All of these little gray areas here, here, these are all recessions. And the unemployment rate doesn't just make a base like it's doing an upturn and then go sideways, right? It never made a base right here and then went sideways, right? It doesn't do that and then drop, or make a base, consolidate, and then drop, right? Make a base, consolidate, and then drop. That's not the case. Whenever these things form a bottom, which is very clearly what we're doing right now, right? We have a nice rounded bottom here. The chances that this is just going to move sideways and drop are very, very small. Okay. Now there is a chance of that. There's always the chance that this time is going to be different. But when you look historically, most of the time it's not different, right? Most of the time we do end up seeing this rapid rate, increase in the rate of unemployment. And this chart goes all the way back to the 1950s. So it's not like this is like some small short time chart or anything like that. I mean, pretty much every time, like even when we get small little bases over here, you can see that we still end up, rocketing back up higher. So, the unemployment rate to me is really signaling that we could potentially be on the verge of a recession coming very, very soon, right? Within the next 6 months. 3 months ago, 3 months ago, we weren't necessarily there, right? We were starting to see it, just not go down anymore. Okay, but it's been very choppy, right? And COVID kind of messed a lot of things up, right? The pandemic. And so it hasn't been as clear. But I mean, if you look at the most recent example, we look like we're basically right here right now. And like we could potentially see this massive spike in unemployment sometime in the near future, right? Within the next 6 to 18 months. Now, there's also an employment population ratio model. Okay, this is what people call the EPR model. This is something similar to the Som Roll. Okay, this is something newer that not a lot of people know about. And I basically input all of the conditions into a script, into Thinkorswim, to where it makes it nice and simple and easy to visualize, right? So you don't have to be necessarily a mathematician or an economist to know when is the EPR model signaling a warning sign, right? And that's basically once we go yellow, right? So once we go yellow, that is bad news, right? You can see the dot-com bubble up here, right? We go yellow right over here, and you see we have a large drawdown in the stock market afterwards. Same thing over here in the great financial crisis, right? We go yellow right here at this point in time, right? And then we see a large drawdown in the stock market afterwards. We also had COVID, right? Obviously, the stock market peaked up here, huge flash crash, right? We went yellow. But these two examples right here are really good examples of, the indicator, and you can see it's flashing yellow right now, and it's been flashing yellow for a couple months. This is a really big warning sign, right? Because most of the times when we've seen this, it's led to large drawdowns in the stock market and has also coincided with recessionary periods. And we're not going to dive too deep into the mechanics of the employment population ratio model, but a 3 is a good score. Okay. And then once you drop down to a 1, that's not good. That's not good at the employment population ratio model. And then below there often signifies that you're in a recession currently at the moment, right? So, this does not look good. And this is something that I've been waiting to test out in real time. I came up with that last bear market, and now it's flashing while we also have the unemployment rate looking like it's making a base. Every time the unemployment rate has made a base, we've shot up higher. So there are lots of concerns and valid reasons to be concerned. Now let's go over another one right here. So I also came up with a script for the economic cycle. Okay, this is the economic cycle right here. You have expansion, peak, contraction, recovery. Now, what we've got on this chart, okay, let me go ahead and show you guys the labels. Green is the expansion, blue is the peak, red is contraction, and yellow is recovery. Okay, so if we take a look at where we're at right now and what we're facing, this is basically where we're at. Okay, expansion had a blow off top, right? The last time we saw a blow off top in expansion, well, that was the very beginning of the last bear market, right? We saw this huge, massive blow off top. It's very similar to the move that we're having right now, right here. We're seeing something very similar right now. Now, what did we have back then? We also had new all-time highs in the contraction phase, right? So we had new all-time highs in the contraction phase with a blow off top. Now, it is common to see some of these move down similarly, during the same time period, right? So they both of these could have peaked right around the same time. But what's going to be more important to me is over the next, 2 to 3 months, I want to see what happens with this, right? Does this continue to head lower while this actually makes a higher high? If so, that's pretty much going to be a confirmation that, we are in fact in a contraction phase. So when you think about a recession, right? Yes, unemployment, the labor market does have a big part and play a big factor in a recession, but you also have to have economic contraction, right? And oftentimes this is, in something like GDP, and the market is going to price these things in. Okay, the market's going to tell you a story. You just have to know what to listen to, and you have to know where to listen, right? It's kind of like a radio station, and the stock market's got 3,000 different radio stations. One station could be telling you the right things, but if you're not listening to that one and you're listening to a different station, then you won't hear the right news. So this is one of those things, along with unemployment and along with that EPR model, that does have me worried. And so we need to see how they're going to develop, right? It doesn't mean for a fact that we're going to go into this massive recession and we're going to go and see a 50% sell off in the stock market. That's not what I'm saying, but these are the reasons for concern, and they are valid reasons, and we're going to have to monitor them and see how they develop. So is it the best time to be going full margin and full risk on and trying to be overly aggressively risky right now? No, it may not be, right? There's a lot of things that are worrisome, and we need to see how those things develop, but it doesn't have to mean the end of the world, right? You can position yourself, you can hedge yourself, and you can just monitor these things and see how they develop, right? If we start to see a strong recovery in the expansion phase and we make new highs, that's going to eliminate a lot of the worries, right? Especially if we don't get the divergence where we had expansion go down and make lower highs while contraction made higher highs. That's going to be a strong sign to me that we need to be really cautious of a recession and the fact that we're in the middle of a recession and could potentially continue to head lower, right? This is the economic cycles right here. Again, you can take a screenshot of this. You can just Google this chart, and it'll tell you what the outperformers are in each of the phases. And this is essentially how we come up with the script right here, by measuring, the top outperformers in each phase, and then color coordinating it to make it nice and simple for you guys to visualize. Okay, now you throw in all of this combined with the inverted yield curve. Okay, this is the yield curve right here. All right, we have the Fed funds rate in purple. The yield curve is going to be the ultimate Fed funds rate indicator. Okay, what do I mean by that? Well, if you take a look, each time that the Fed has cut rates, which is going to be the purple line going down, the yield curve is no longer inverted, right? You see here, we're no longer inverted, and then the Fed starts to cut rates, right? Here, we're no longer inverted, and then the Fed starts to cut rates. Here, we're no longer inverted, and then the Fed starts to cut rates. That's just what happens, right? And that's part of the mechanics behind it. So where are we at right now? Well, if we look, we're basically in a bull flag, right? We could call this a bull flag right here. And if this breaks out, it looks very likely that the yield curve will no longer potentially be inverted. And if that happens, it's very likely that we end up seeing the Fed start to cut rates. And what's been happening since the yield curve uninverts and is no longer inverted, and we end up getting rate cuts, well, we've seen significant sell-offs here and here. And these also happen to be right around the dot-com bubble and the great financial crisis. So you combine a lot of these things together, and it does make a lot of sense why there is this recession obsession happening in the market right now. There are valid reasons for concern, and there are important things that we need to continue to monitor and see how they develop. Okay, you combine all of these things together. All right, even adding the gold copper ratio. So essentially what you're looking for with the gold copper ratio is, you have this initial thrust, okay, and then you get this large move to the upside afterwards, right? You have an initial thrust and then a large move to the upside afterwards. You have an initial thrust, right? And each time after the initial thrust, you always get a pullback, right? And if you take a look at what we've had, right, we've had I marked this last time as a thrust, and we've had a pullback, and now we're thrusting up higher. Okay, and so it's very possible that we could be heading into a bear market, because that's what this indicator has shown us previous times in the past, right? Here was the top over here, and then we had the thrust after the pullback. Okay, here was the top over here. We're above that level. We had the pullback, and then we had the thrust again. Here was the level here, and we're above that level here currently. So this is another thing to monitor, right? And the ratio between gold and copper, because essentially gold is seen as a more safe haven, okay, typically risk off. All right, and people aren't getting into gold because they're a super risk on asset. And meanwhile, copper is kind of seen as a measure of the economy, right? And how is the economy doing? What does the economy look like? A lot of people look at copper for that. And so if you see gold outperforming copper in these massive periods, right? And you get these massive spikes and massive periods, well, it's telling you that investors are seeking a flight to safety, and that copper is underperforming gold, meaning that there is not a strong, sense of economic growth or economic strength in the markets, right? In the currency markets and the metals markets specifically. Now, credit spreads, okay? If you take a look at IEFLQD, huge, massive spike up in here, okay? You want to see this moving the opposite way of the market, right? When the S&P is going down, you see we have the credit spread measurement here rising. This just lets you know that things are moving accordingly, okay? As we've seen the S&P 500 continue to rise here, we've continued to see credit spreads stay relatively flat and in a downtrend, right? That's been a positive for the market, and really just justifying a lot of the positive movement was that we're not seeing in the credit spreads market and via credit spreads, we're not seeing this massive recessionary fear being priced in. Well, here recently, we've gotten this massive spike in our credit spreads measurements here, and that is a huge warning sign, a huge red flag that the bond markets, right, and credit spreads are pricing in some type of danger, right, and some type of a weakening economy. You can take a look at a different form of credit spreads, right? If you look at the HYG IEI, again, we have the S&P on the top, and we had a divergence. Okay, this was a big warning sign to investors and to the market, where hey, the stock market was rising here, but we were seeing lower highs in our credit spreads measurement. All right, and we just completely rolled over, right? We had basically a top here, a nice rounded top. We flushed through there. We're seeing a massive flush to the downside right now. This is not really a great sign. This isn't a sign of strength. This isn't a sign that people are looking at the economy with lots of optimism. You add all of this together, and again, it's just one more of the things combined together that have really fueled the recession obsession that we're seeing all over social media and financial Twitter. Now, join the Discord, okay? Get into our private trading group using promo code SUMMER. It's just $1 right now, okay? So you guys can get in using that promo code for $1, test it out, see what it's like. If you don't want to stay, then you can cancel, and you only paid $1 for it, right? So, what's inside? You get 20 plus swing trade ideas every week, custom scripts and indicators. So, these economic cycles, right? These EPR models, these gold copper ratio charts, a lot of the charts that we looked at that are my own charts and not some stuff from Twitter or whatever that I put in the video. Those are all available to Discord members, right? All you have to do is copy the little link, paste it into your Thinkorswim, and you'll be able to have those, and you can save those different chart layouts on your flexible grid and easily access them. It's a really great resource. There's also exclusive intel inside of there, right? We've got unusual option activity, dark pool data, gamma levels, and more. This is all available through the stock bot that we have inside of there. You just type in a couple quick commands, and all of that access or all of that data is accessible very easily and quickly. Now, there is the newsletter. Okay, that's completely free. You can sign up for that using the link in the description, get those sent directly to your email inbox, or you can go ahead and just check out the website, right? It is in blog format, so you can go back and read some of the previous articles. We had tons of great trade ideas come out over the past month or two. A lot of those worked really, really well. And looking forward to providing you guys with some really good info here in the future, even through this really big market volatility. So thanks again for watching. Smash that like button, subscribe to the channel if you guys are new, and I'll see you in the next one.